What's up everyone, it's Kadi with MoneyVest. So in this video, I wanted to go over some scenarios and some possibilities for the markets here over the next 3 to 6 months and kind of run through some different situations which are going to be driving equity returns moving forward, because there's this one thing that really is going to dictate where markets end up going. Okay, it's not inflation, it's not recession, but it's this one metric which we have again covered at length extensively on the channel before, because at the end of the day, when it comes to the market, everything is an opportunity cost, right? It's a relative selection game where you are investing in one stock or one asset class versus another. So in order for liquidity at the end of the day to come into the equity markets, equities in general need to be more attractive compared to some of the other assets out there. So that's what we're going to discuss. Hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like and don't forget to subscribe to the channel. I would really appreciate that. And link to our Discord and Patreon is going to be down below. Again, you do get access to all the benefits, including members only private videos. There's over 40 plus lectures and tutorials, full access to all the spreadsheets, including our Discord channels, over 20 of them, and the buy and sell alerts, options alerts, trade ideas. Everything is going to be included with the link down below. And there's also going to be a comment pinned that's also going to have that link if you want to join. So what we are talking about today is, of course, rates, interest rates, and treasury yields more specifically, which are more of a function of market demand and market supply. This right here were some of the articles and reports that I want to go over. I mentioned this in our Discord, which this Mike Wilson guy needs to just call it quits. I mean, this is getting out of hand. I mean, he's talking about how falling inflation now and rate cuts may be bad for stocks. Now look, it's kind of a difficult battle here, because what he's talking about makes sense, right? Only in a very certain environment, okay? So that's something that we have to obviously keep in mind. And there's another report that came out, from UBS that basically mentioned that rate cuts are going to be as aggressive as 11 rate cuts is what the Federal Reserve is going to do in next year, because they are expecting a recession in the second quarter of 2024. So 275 basis points of easing is what they are expecting. So the Federal Reserve is likely to make significant cuts to interest rates next year, beginning as early as March, and they are expecting 2.75%. So if every rate cut is 25 basis points, that will end up being closer to 11 rate cuts, and the market's only pricing in 4. So you can see that almost 3 times as much as what the market's pricing in, and over 6 times, 5.5 times than what the Federal Reserve has penciled in into their SEP. The firm predicts that the U.S. economy will fall into a recession by the second quarter of next year, enabling a rate cut, and rates will fall as low as 1.25% by 2025. Other predictors, however, have anticipated just a 0.75% drop starting in summer. A much more conservative forecast on Wall Street has been split on predicting the Fed's movements as well. And what Mike Wilson from Morgan Stanley is saying is, he would argue the exact opposite, that when rate cuts and inflation falls, that's actually bad for equities. And he says because the moment it's clear that the Federal Reserve is done raising rates, there's going to be an incredible movement into the bond market. And this is something that I cannot disagree with. I think there is some truth to this idea that, given how high the yields are, so if you come over to the 10-year treasuries, and they're sitting at 4.5% right now still, right, literally exactly 4.5. We have been coming down from highs of 5%, so we've already dropped to 50 basis points. And now I think the shift of focus is going to be on the longer end of the curve. A lot of people have been running ladders on the 1 month or the 6 month or the 3 month bond, which is exactly why it's been so stable, because the demand is still there, and they're able to roll out these bonds every single month because they're getting an annualized return of 5.4%, which is very, very good. But eventually, when the rates actually start getting cut, or we start seeing some easing in the interest rates, where the Federal Reserve comes out and is very clear and very transparent in their idea that, okay, we're done raising rates. Like we're not going to be raising rates anymore, because we believe inflation's on the way lower, on the way down, and there is some softening in the labor market. So we are good. We're done. Is the moment when I think the 10-year, the 20-year, and the 30-year becomes incredibly attractive at these levels, because we haven't seen these rates in over 16, 17 years. Most fixed income traders and bond traders and investors for the longest time have not been able to lock in rates such as high as 4.5, 5% and higher. Like if you take a look at the 20-year, it is going to be sitting at over 4.85%, not to mention the 30-year is sitting at 4.66, right? So these are very, very good rates that the bond investors, especially endowment funds and sovereign funds and funds that don't necessarily are in the business of beating the market, right? Who is beating the market at the end of the day? It's only hedge funds, it's institutions, it's retail, it's a lot of portfolio managers, right? It's not the large capital allocators. They're not in the business of beating the market and putting out these prospectuses for investors to look at and invest more money with them. No, they're basically managing money for universities, for countries, for different funds, for pension funds that just want to make sure that the money is preserved and it's earning a decent rate of return and it's beating inflation, right? There's two different markets. There's markets for beating markets, as what hedge funds or portfolio managers are doing, and there's a market for beating inflation, right? Just keeping in line with the fact that purchasing power of that capital is growing. And that's where these rates become very, very attractive, because even on a real inflation adjusted basis, these rates are very, very good. So I can't fully disagree with the analysis of Mike Wilson, but yes, I think he has changed a lot of his analysis and perspective on the market, given how much it's already rallied. So he's always come out with different theses to bring markets down and saying that, okay, markets are going to get lowered. What I will say is that as markets continue to move higher, as we have discussed in our market updates videos, the price to earnings multiple obviously expands, goes from 18 to 19, 20, 21, 22, and we're looking at earnings yield on the S&P 500 to get dropped, right? So we're going from, let's say, 5.5%, 6% to 4.5%, 4%, and that on an opportunity cost basis, on a relative selection basis, makes the bond market a lot more attractive than stocks. Now, that's not going to last forever. That's another thing that we have to understand, is that it's not going to last forever. The equity risk premium is going to get better as yields come down. And how are the yields going to come down? When liquidity floods into the bond market in the first place. So that's something that I'm kind of envisioning moving forward, is the moment we start to see rate cuts, or at least an announcement of rate cuts, or something that's going to be very similar to a pause and we're done hiking, it's possible that liquidity floods into the bond market first, right? Takes out the bond market, yields get dropped, and yields will drop to a level where bonds are no longer attractive relative to equities, and that's when any ripple effect is going to take equities higher from that perspective, because then equities will become more attractive relative to bonds. It's going to happen in a little bit of a chronological order, but the only reason we're going to see those rate cuts in the first place is if the Federal Reserve is confident that there is inflation back to their target, or is on its way back to the target, and the economy also needs rate cuts. As I mentioned before, that the Federal Reserve is not going to cut rates just because, right? They're not going to wake up one day and be like, you know what, let's just cut rates today. No, they need an incentive. They need a reasoning. They need something to fix, right? Otherwise, they're just not going to embark on this rate cutting cycle if there's nothing to fix. And by fixing, I mean there needs to be either deflation, or there needs to be a recession, there needs to be high levels of unemployment. Only then they can justify cutting interest rates. If the economy continues to be strong and resilient and inflation is on its way lower, they're doing their job. And as a result, there's not going to be any motive or incentive to cut rates. So that's where we are. And look, from a long-term investment perspective, I'm still going to dollar cost average into VUG, SMH. That doesn't change. That's going to happen on a more weekly or a monthly basis or bi-weekly basis. That's going to go on as usual. But when it comes to individual stocks and just trading opportunities, I think the markets obviously are overbought here. And I'm not necessarily going to be looking into TQQQs or even individual stocks for that matter, just given how overbought we are. And from an earnings yield standpoint, we're quite comparable to bond market, right? And from a attractive risk reward attractiveness standpoint, bonds certainly look a lot more attractive relative to equities, at least right now. But on the next pullback, when our indicators get hit when it comes to volatility, the market breadth, percentage of stocks trading below above their moving averages, and not to mention the RSI, the MACD, so a lot of the other technical indicators that we look at, then yes, I think there will be a lot of trading opportunities for the market. But the bottom line is that if you are investing for the long term, like I am in a lot of these individuals, stocks and ETFs and diversified funds, then of course price action doesn't really matter. I'm going to be dollar cost averaging at lower levels as I can and on a more frequent weekly basis. But when it comes to individual stocks, obviously that strategy doesn't quite apply because you want to be looking at valuations and technicals as well. And if you are strictly trading, then price action is everything. Sentiment and technicals are going to be the best guide. So let me know your thoughts down in the comment section below. So in my opinion, I think if there is a recession, which I wouldn't be surprised if there is, I've mentioned this before, given the rates that are higher for longer, and there are some signs showing some signs of cracks in the labor market, then that's going to be enough of an incentive or a motive for the Federal Reserve to cut rates. However, at that point, inflation should also be back down to the Fed's target, because if it's not, they're going to be prioritizing inflation over recession. Therefore, we may not see a huge amount of rate cuts. So that's the thing, right? If there is a recession and there is inflation still high, and the Federal Reserve prioritizes bringing inflation down, and there are no rate cuts, then equities could really be in trouble in that scenario. Because at that point, rates are high, recession's underway, and inflation's not back down to the Fed's target. Where's liquidity going to go? The bond market. Bond market is going to be very attractive at those higher rates in a recessionary environment relative to equities. And equities in that scenario could be very troublesome only for some time until they drop so much that, again, valuations come down to very, very attractive levels. So I hope you guys enjoyed this video and find it helpful. Make sure that you drop a like and subscribe to the channel. Again, it's it's not a perfect science. It's not something that is going to be very easy to evaluate. It's a constant assessment of all the variables at play here. That's why economics, macroeconomics, is such a difficult discipline, and I think it's useless or irrelevant to try to predict what's going to happen, but really assess where we are and what everything, sort of all indicators and metrics are suggesting, and then make a decision off of that. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Again, 16% annual discount that's available till the end of this month. As always, happy investing. I'll see you all in the next video.